Hello and welcome to another installment of IJS Speaks. This is your neighborhood financial economist, Katie Mark. It is Thursday, December 10th, 11 p.m. Eastern Standard Time. So today we're gonna dispense with the formatting, and I'm just gonna jump right into it. I'm looking at my dashboard and had to do some reshuffling. Still the same five. Still looking at gold, the S&P 500, the dollar index, crude oil, and the U.S. 10-year Treasury. But the grouping is what changes from time to time. So basically, now I'm having a hard time because of qualifying. I'm having a hard time qualifying these groupings as risk assets versus safe haven assets because of the mix. But I'm looking at right now crude oil and the 10-year U.S. Treasury trading in tandem, roughly, while gold, the S&P, and the U.S. dollar trade in tandem, roughly. So the dollar is basically, it's trading as, it's not the linchpin this week or basically it's not the North Star this week on the dashboard. The 10-year Treasury is acting as the North Star this week. So the 10-year Treasury, following its fundamentals, is seeing price appreciation in the 10-year Treasury. All right, so yields down, basically, price up. That lines up with what's happening in global bond markets, especially with central banks and monetary policy. At this point, as far as the developed Western sovereigns go, the U.S. 10-year Treasury is one of very few 10-year sovereign notes that is still yielding positive. So that automatically, in my mind, attracts international investment. Then we also have the Federal Reserve, which short-term interest rates are at zero. So in order to expand their accommodative monetary policy stance, they would just have to move further along the yield curve. And something similar to their Operation Twist, where they start attacking the longer end of the curve. The last time they did this, they went after the 10-year Treasury, and if the Fed wants to further increase its accommodative stance by increasing the money supply, they can buy 10-year Treasuries and pull the instruments out of the market and introduce money. So, yeah, the 10-year treasury going higher, just, the price is drifting higher, following along its fundamentals, is acting like the North Star this week on the dashboard. So, 10-year treasury, risk-free asset, that's my safe haven asset. Okay, so I found my linchpin, my North Star. Trading in tandem with my risk-free 10-year treasury is crude oil, which typically trades in tandem with the other risk assets. So this week, for whatever fundamental narrative you want to apply to it, crude oil is trading like a safe haven asset, which leaves gold, gold, the S&P, and the dollar to be our risk assets. So on a typical week, the dollar is your safe haven, representing investors' need for liquidity. And the 10-year would be the safe haven, representing investors' need for liquidity and a little bit of premium. And the rest would be your risk assets. This week, at least coming out of the second half of the trading week, we have crude oil trading like a risk asset. Crude oil trading like a safe haven asset, along with the 10-year treasury. And then we have gold, stocks, and the dollar trading as your risk assets. With that layout in mind, the dashboard is pointing risk off, because, like I said, the 10-year treasury is following its fundamentals, and the fundamental reason for the 10-year treasury note to appreciate is all bad. So, and crude oil is appreciating alongside the 10-year treasury. When I look at those two side by side, the thing that immediately pops into my mind that they have in common would be inflation or inflation expectations. Because crude oil, alright, that's, the price of crude is factored into so much that rising crude oil prices typically means rising prices in most other things eventually. And rising prices typically signify like a positive outcome for an economy, because it stimulates activity, it stimulates investment, But I guess once you have price increases that are out of control and you have inflation, hyperinflation, and that's so. I guess, long story short, too much of anything is bad. So crude oil rising is technically a positive, but then at the same time you have 10-year treasury prices increasing. So maybe it's not from a demand side that's pushing up crude oil prices, because that would be a positive. Maybe it's a supply thing, So then to push prices up, demand being equal, you would have to cut supply. So is that what we can expect out of OPEC? Supply cuts to push the price up? I mean, personally, I don't think OPEC's in a mission to push oil prices too much higher above where it is right now, because then that would put the price of oil back in the range of break even for some US shale producers, and I doubt OPEC wants to start bringing shale production back online because they have no control over what the US shale producers do. But if they can keep the price of oil just below their break even, they can effectively starve them out. So I don't see too much more appreciation in oil above where it is right now, but at least as of this week, it is trending higher along with the US 10-year Treasury. And then we have gold showing weakness, the dollar showing weakness, and the S&P showing weakness. But they are all at pivot points. So going into the end of the trading, going into the final trading session or trading sessions for the week, the sentiment is primed for a reversal. The safe haven assets are trading close to their pivot points, which are typically the support and resistance areas where the price reverses, or if it breaks through, then it just continues, and it usually continues with momentum. So I'm looking at crude oil trading at or around a pivot point, and the 10-year Treasury as well. So is gold, the S&P, and the dollar. Now my indicator is my linear regression slope indicator is suggesting that the momentum is positive on crude oil, but it's slowing. The same for the 10-year, more so for the 10-year actually. Meanwhile, the momentum on gold is it's negative, but it's becoming less and less negative. The same for the S&P. The dollar is just pointing downwards. So maybe the dollar keeps falling. That's the dashboard. And on the trade book, the trade book is actually pretty simple this week. There's not a whole lot going on. We're towards the end of the year. Everyone's closing out their books. And there are a lot of distractions in the real world. So I'm not necessarily trying to be too preoccupied with what's happening in the financial world. I mean, a few weeks from now, we'll be back to business as usual, trying to figure out, what's the next best move to make with your money. But for now, well, at least going into the close of this week, I've got a long position or a long option. I've got a call option on the 10-year Treasury, got a call option on gold, and I got a call option on the S&P 500. So with the 10-year Treasury, the call option is basically just there to capture that price drift as it stays on course with its fundamentals. The position on the S&P 500, I'm attempting to catch a swing in sentiment to close out the trading week, as there's been a lot of positive vaccine news, and the market in the last couple of trading sessions hasn't really been responding to that news. So we'll see if there's a little bit of sentiment covering as we go into the last trading session of the week on stocks, and that's what I'm looking to play with the call option on the S&P. Similar with gold, if the dollar keeps falling, it keeps pushing lower, that should also put a floor on gold and even push gold a little bit higher. So that call option on gold going into the last trading session is meant to take advantage of that if we do see the dollar continue to fall into the Friday sessions. So simple position, simple exposure. As it currently sits, the 10-year Treasury options in the money, the S&P and the gold options are out of the money. And then, of course, the equity side of the portfolio. Nothing necessarily new to report. I have been trying to manage the exposure, and this is just me experimenting with it, trying to manage the exposure in the equity side of things. So what I mean by that is, when I see a running trend in the S&P higher, whenever there's a leg up and then a consolidation, I would trim the positions in the portfolio. And when I trim the positions, I trim the entire portfolio, so I maintain my ratios. So I have a very simple portfolio, 5 instruments, 20% equal weighted, and I just let it rip. So I'll trim the whole portfolio, maintaining my ratios. If something is profitable, it's profitable. If it's not, it's not. And I wait for pullbacks. When I see pullbacks, if I happen to have the cash available in the portfolio from trading other instruments, then I recommit the cash to the equity side of it, to the equity portfolio. And I mean, it's been interesting. It's been a new take on it. I've missed a couple opportunities because of trying to time the market, but there were also a couple times when, and I mean, I was able to sit out for, a portion of a pullback, but usually I was on the quick side to get back into the positions. So basically, when I paired my positions, I saw a pullback, I would start repositioning maybe a couple sessions too early, and leave a little bit of risk out of the portfolio, basically. But I mean, it's a work in progress because I also get to trade other things around it. So yeah. But I mean, that's it. Just wanted to highlight that that switch on the dashboard with crude oil and the 10-year treasury. It's just interesting to see an asset like crude oil trading in tandem, or trading like a risk, a safe haven asset. But I guess it's similar to when the Nasdaq trades like a risk asset. When the Nasdaq is up and the Dow and the S&P are down, that's typically when we see worsening of COVID news. And then vice versa, when the Nasdaq is down and the S&P and the Dow are up, we typically see an improving situation. So the assumption or the reasoning is the tech stocks on the Nasdaq benefit, or the Nasdaq benefits more or to a greater proportion because it's more heavily weighted in tech from worsening COVID numbers, because then more people have to stay at home and work remotely, versus the Dow and the S&P, which is in the case of the Dow is more industrial, and in the case of the S&P is a little bit more representative, I guess, which do better when COVID numbers or COVID news is getting better, and you have, I guess, increasing optimism or improving outlooks about getting back to a more normalized, ways of doing business. So it's a similar twist, I guess. Eventually, it'll just drift back into its normal way of doing things. But that's the trade book going into the Friday session, and that's the dashboard going into the Friday session. Yeah, I just wanted to throw that out there before I call it a night. And on that note, if anyone has any questions, comments, or concerns, you can email me at contact@runthenumbers.biz. That's contact@runthenumbers.biz. Until then, this is your neighborhood financial economist, trader, and all around bad motherfucker.